welcome back. It is a new episode of my podcast. I am Moumita. In today's episode, I will be talking about the important economic and financial indicators and events from last week. We will begin. Monetary policy of New Zealand. The Reserve Bank of New Zealand increased its policy rate by 50 basis points. Now the policy rate stands at 1.5%. The increase in the policy rates has been due to the rise in inflation and rise in inflation expectations. The last reading of inflation was 5.9%, which was the quarter ending December 2021. The Reserve Bank of New Zealand has an inflation target. It wants to keep inflation between 1 to 3% on average over the medium term. Moving to the Monetary Policy Meeting of Canada, the Bank of Canada also increased its policy rates by 50 basis points. The current policy rate stands at 1%. The central bank expects the inflation to remain high at around 5 to 6% this year. The bank has also guided that there would be further rise in the policy rates in the coming policy meetings. Also, the central bank wants to start reducing its balance sheet to reduce the liquidity in the system and bring down inflation. Moving to Eurozone, the European Central Bank held its monetary policy meeting last week. As expected, the central bank kept its policy rates unchanged. However, the central bank has reaffirmed that the quantitative easing program will come to an end by the third quarter. But the central bank will continue to reinvest in full the principal payments from the maturing securities purchased for an extended period of time. Why? It will be doing so to ensure that there is adequate liquidity in the system. The ECB will start its policy normalization cycle after the quantitative easing program comes to an end. The ECB has also said that any rate hike will only be a gradual process. Moving over to USA, sentiments. The sentiments measured by the University of Michigan showed an improvement in April. This improvement was much higher than expectations. People are feeling more optimistic about the short term, more confident about the business conditions and personal finance. However, the anxiety over inflation continues to be there. Talking about inflation, there was a sharp jump in the consumer price index inflation. The number stands at 8.5% in March. The most impacted was the energy sector. USA had banned some Russian energy commodities. This has led to a rise in the crude costs and gas prices. Alongside, food prices also jumped, with the cost of groceries going up sharply. This is in line with the rise in the global agricultural prices. On the other hand, the core inflation, which is inflation excluding food and energy, which is also seen as a trend inflation, also continued to rise. If the central bank sees the rising inflation as a trend, then it may aggressively increase the policy rates in the MPC meetings. A rate hike of 50 basis points in the May policy meeting is quite possible. Moving to India, trade deficit. The exports exceeded $40 billion in the month of March. This was higher due to higher export of petroleum products, engineering and leather goods. Within imports, gold imports remain low. For the full year, the trade deficit stands at $192 billion. This is a high trade deficit and would lead to a high current account deficit. This was likely to adversely affect the reserves and the exchange rate of India. Industrial production. The industrial production growth for the month of February was released last week. As anticipated, the number remained low. The demand for manufacturing goods continued to remain low, especially consumer durables and consumer non-durables. There was also a persistent weakness in the capital goods sector, which implies that the investment cycle is yet to turn around. On the other hand, sectors like mining, electricity, and infrastructure reported good growth numbers. In the next few months, the high commodity prices, which implies high input cost, along with the shortage of raw materials due to the lockdown in China, may keep the industrial production growth low. Inflation. India's consumer price inflation reached 7% in March. This number was much higher than expectation. The rise has been driven by a high food inflation. There are multiple factors at play. There is a rise in the global commodity prices, which is causing pass-through of high input cost. Also, there is unfavorable base. The inflation rate corridor of the RBI is 4 to 6%. RBI wants to keep inflation within this band. A number of 7% means that this is the third month that inflation has breached the upper ceiling of 6%. If if the inflation reading continues to remain high in the coming months, then the RBI is likely to increase the policy rates to reduce inflation. Thank you for listening. I am Moumita. Bye bye.